Morgan Stanley's top strategist, Mike Wilson, says a 10% correction remains the most likely outcome in the near term. Joe Terranova, I want you to tell me whether you agree with this call. He says last week's failure to break through technical resistance for the second time suggests the correction isn't over. He expects softness into and past the election before the next leg of the bull market. Does that make sense to you? Do you agree with that call?
So last Monday, we got up to 35.49 on an intraday high. The previous high on September 2nd was 35.88. So we came close. The reason we pulled back, Scott, is that the absence of a stimulus deal. The conditions are fully in place right now to exceed that 35.88 high. When you look at retail sales in the U.S., when you think about the strength of Chinese economic numbers, think about the fact that yesterday we had the single largest travel day here for the airline industry in the United States. Clearly, the conditions are in place. And if I look within the markets itself, it's just not technology. On Friday, reaching 52-week highs, air freight and logistics, construction and engineering. So the conditions are there. It's the absence of stimulus. Now, for a 10% decline, the way that you get a 10% decline is if you price back in a contested election, which we have already priced out. If we don't have a contested election, we are not going down 10%. I believe the conditions are still favorable to move higher.
All right, Jenny, I want to know if you agree with that. Joe talks about the conditions, okay? Let's talk about those conditions. 2 weeks from tomorrow, Election Day, all right? We got the virus. Cases are rising. Hospitalizations are rising. You've got earnings coming this week, 80 S&P companies. Are the conditions ripe for a correction, or are they ripe for new record highs?
I don't think they're ripe for that kind of correction. In terms of new record highs, we're pretty much there. So do we sustain these levels, or do we just bump along between now and year end? I don't see any reason why we should surge higher from here, but I also don't see a reason for a huge correction. In his report in Morgan Stanley, he talks about exactly that. Stimulus, election outcome timing, third wave, and then valuations. So those are his reasons for why there could be a 10% correction. I think we've factored most of these things in. We know that we're getting stimulus. We don't know what it's going to be. We don't know the timing. We know that a vaccine's coming. We don't know when. We don't know the timing, but we know it's coming. We know that the election results are going to be over. Joe brings up a good point. If it's contested, that could create some bumpiness. But I even think that is to some degree in people's expectations, or rather the risk of that, the percent chance risk of that. And then you've got valuations. I think what we're going to see in third quarter earnings is we're going to see the base continue to be built. We're going to reflect back on what happened over the past quarter. And when we reflect back on that, we're going to see that we've returned somewhat to a more normal pace. Even though cases are rising, we're behaving far more normally than we did 6 months ago. And that's really positive. So no, I don't see a huge catalyst for a big correction from here.
Rob, I hear complacency. I hear, you know what, the market, it's elections priced in. We're not going to have a contested election. Even if we do, it's not going to be a big deal. Virus cases are rising, but we know how to deal with all that now. Does that make sense?
It does and it doesn't. I will tell you that investor positioning is still way off sides. I still think there's a lot of investors that are hedging a contested election outcome. They're nervous about the election, and therefore their positioning reflects that. So I would look at Mike's note and say, sure, we can see a lot of volatility because there can be surprises along any of those things that he's talking about. However, positioning is broadly reflected, and I would say that most investors are slightly underinvested to their target positions going into the election. In addition, I think the best way to play this going into the election is play the broadening out. I think when you move into the post-election framework, which is one where, as Jenny said, we'll know the election outcome. We will obviously have some sort of stimulus package next year.
How do you know we're going to know the outcome? That's what I'm talking about, this whole idea of complacency around the election. All of a sudden, the pendulum has swung hard towards, oh, the election's not going to be a big deal. It's not going to be contested. We'll know the winner. How do we know? How do we make such a big leap and suggest that it's all going to be smooth and clean?
I do think it's too much of a presumption, Scott, to say that once we know the election outcome, that ultimately we're going to know the policies that come out of that. Listen, it's not a fait accompli that stimulus goes through very easy. What if we're in a lame duck session and Biden is the president? Do you really think we're going to get some sort of stimulus package that's significant across that and between February? I think maybe it's delayed a little bit, and that's where I think you see volatility. In the intermediate term, I think we are going to get answers to these questions. I think we are going to have a vaccine. We are going to have better therapeutics. Markets are going to reopen. But in that interim time period, people are going to reassess, okay, where are we from an earnings standpoint? What does this mean? And that's where you see volatility. And that's where I think you get positioned to kind of look forward into 2021. And I think broadly, I'm a little more optimistic about that than this interim period.